Hey guys, it's time for another weekly S&P 500 price and earnings update. See where we're at. This was an extremely busy week as far as stock earnings updates were concerned. So let's get into that. All right. Again, for those, a reminder for those of you guys who maybe not so familiar with how things work when it comes to stock prices, they are based and very largely on earnings. Okay, what are earnings actually at, and what are they expected to do? If you know what's going on with these, then you'll have a pretty good idea what to expect from the price behavior as well. And that's why I do these updates for you guys, as well as for myself or my own analysis, whatever. So, gonna get into that. I know a lot of you guys who are TSP only investors is kind of be over your heads to an extent, but again, the more you try to learn, just little nuggets of knowledge, the more, I always say treat it like a jigsaw puzzle. You have a bunch of little pieces that won't mean anything to you. It's all Greek at first. But then once you start putting a little, some pieces here together with pieces there and so on, then it starts making a little more sense to you. It's an ongoing, lifelong process of learning new things when it comes to what things happen and why and stuff. But just the more you progressively learn over time, the better off you're going to be, right? So that said, let's get into these earnings. Also, before I get into it, I'll just say that this video is formatted, particularly with desktop users, or even if you have a TV or something, whatever you happen to be watching it on, in mind, because I will be posting it on my YouTube channel as well, and as well as on Discord. And some of you guys might have the ability to watch it through a TV. You have a better view there than on a phone. Okay, so if you can turn your phone sideways, if you have something better to use than a phone, I want to use it instead, so you get a better look at what we're dealing with here. Okay. That's it. All right, let's get on to the data. Let's go and give you a summary view first. Last week, I had 110 companies total updated at that point in time. As of this weekend, we are up to 283. More than half of the entire S&P 500 index is now reported updated earnings for the quarter. All right, so where are we at now? We are at 12.66% year-over-year growth from those 283 companies. 231 have reported positive earnings growth. Only one is neutral, and 51 are negative. 81%, almost 82% of the companies are reporting positive earnings growth. That is really good breadth. Okay, so I had a conversation with, I guess I can call him a friend of me in a way, and I mean that in a very complimentary way. David Morrovan. He's very bearish in general, and I like battling with him. He's actually got some intelligent stuff he talks about. So, but at the same time, it's one of those agree to disagree situations here, right? He posted on his page about lack of breadth across the S&P 500. Generally, I think that breadth is more price based, and it's more focused on all the strength is in the tech sector, and not really any strength anywhere else. But outside of what's actually going on with prices, because I don't know if that lack of breadth is because everybody's getting their normal attention that they should be compared to what earnings are there, but tech's just getting too much, or if maybe the other groups are not getting enough attention that they really should be getting, and tech's just where everybody's focusing their attention when there are a lot of other companies that are doing adequately well to justify the overall index trending upward. All right, so 81%, that is very high. That is very high. Let me scroll up. I have had as high as 87.9 there. On the 11 years that I've been tracking this data, 87.9 is the highest I've ever seen as far as the positive breadth is concerned, and that's a very positive thing. Look at this, 27.1% year over, 12-month earnings growth at that point in time. And then the next 3 quarters right after that, we were seeing 40+% growth. And that justifies some really strong price growth to go with it. Okay, so when we get really strong breadth, that's better conviction that we have a bull market for good reason here. All right, it's we're not seeing the kind of 12-month growth right now that was seen then. We're just barely pushing 10%. So that kind of gives the impression that there's, a large number of companies are not putting out strong numbers, but they're still putting out growth in general. When over 8 out of every 10 companies in the index is reporting positive growth. That should be seen as, it should always be seen as a positive, never a negative. All right, so that looks very good here. Okay, the other thing here, since I'm on this sheet, before I started the week, so if you see right here, like next week, I have 145 companies on the list to look at. Some of those companies were on my radar this week, but they pushed their earnings, their scheduled release dates to next week. So next week, I think I was originally planning on only like 110, 120 or whatever hell it was companies that, or maybe, somewhere in that ballpark, 120, 125, I don't know. And a number of those companies that I was already expecting to report this week are not reporting this week, but actually next week. That said, even with the companies that are now reporting next week, I was expecting to be, with this number here below that tells how much year-over-year growth I was expecting from that particular batch of companies. Before the week started, I was expecting plus 55 points. In other words, add all the companies together and their cumulative earnings per share were supposed to be up 55 points over what they were before the week started. What we actually got, mind you, this is with not all those companies in there reporting that I was looking at. I had over 209, if I remember right. I was expecting 55 point growth from. We actually got 86 point growth out of less than 200 companies, out of 172, 173, I think it was, somewhere around there. So we got even better performance from fewer companies than what I was expecting. So that's a very positive sign there. Okay, should be looked at very optimistically. All right, going to the summary page. Here's where we're at right now. We got a total market cap of 70.604 trillion, and percent growth expectation is about 12.5%. So we're still staying in that same neck of the woods. We had gotten up to just over 13% at the very beginning of the quarter with a small sample size. We started right around 12 before the quarter started. So I would say we're looking pretty good overall. We're right in that neighborhood. 12.5% is definitely, should be something to keep everybody happy as far as what to expect from stock prices. All right. That is definitely going to get you better performance than bonds are going to get if prices actually stay true with earnings. Okay, but now speaking of that, now I did add a couple of extra areas in this chart here. Okay, wait. The trailing and forward PEs. Now I had a different way I was calculating it before, but I've updated that. Basically, it's now more truly market cap weighted, whereas what I had before was just raw, add them all up and add up all the prices, and it's. If anything, it was more earnings per share weighted than it was market cap or price or anything. So, but with that market cap weighting, it looks like we're more at 38 point trailing price to earnings ratio, which is pretty high. I'm gonna tell you that. Forward PE is over 30, almost 30 and a half. It's getting on the high side there. I'm gonna admit that, right? What's coming down the pipeline? That's where that becomes a question. That does seem a little bit on the overly optimistic side. Ideally, really want to see a little lower than that, 20, maybe even 25 at most. I don't follow the Shiller Cape ratio. Some people follow. That's like a 10-year weighted price to earnings ratio that gets looked at, and there's a reason why prices stay up above what the mean is for that ratio. So that's why I don't like to look at that ratio. I don't think it's a reliable indicator in any way, shape, or form. I am totally dismissive of that indicator. However, it's still important to know where are we at with the actual PE, and anytime you see the PE is high or low, whatever, you got to be asking, why is it so high or so low? There could be good reasons why it's so high. We've talked about the CapEx spending by the AI companies, particularly. Are they going to deliver the results that people, there's some kind of expectation that they should, based on how much they're spending on this growth? We'll see. But what could be 30 to 1 price to earnings ratio right now, as far as next year's earnings are concerned, it could we could flatten out, and as far as the price concern is later on, and I don't know, maybe end up and price and the earnings keep going up, where the price is already baked in basically. and we might see some flat periods in the future while prices, the earnings still keep coming up, and those price earnings ratios could work their way back down. The other way that this can iron itself out is if we get not so much heavy influence by the heavy hitters like the Magnificent Seven, and where if that other theory that I mentioned, where with David's post, where there's not much breadth. Okay, if the lack of breadth is only because all the attention's going to these higher power stocks, but not other stocks that are still quality and should be going up, then what's going to happen is, eventually once the sellers start selling their positions on these high-powered stocks, their market caps are going to start coming down, and then they're going to lose influence. You're going to see a little bit of volatility with the broader stock index, but then people are going to start putting their money back into the quality stocks that should be going up. And then when these guys are coming down at the same time, the rest of the group's coming back up. These guys are going to lose even more market cap share on the broader index's performance. So what you'll see is you might see a drop in the price, 5% perhaps, maybe a little more, who knows. 3 to 5% is what you should normally expect on a typical dip, though. You might see a little bit more, and then as people start flocking back to the stuff that, hey, we've got a lot of value buys here that people have been ignoring. They start pushes up the total market cap back up to where it's already at, but the heavy hitters are no longer as high end on that market cap rank. They'll be ranked that high up, but their raw numbers won't be so high. Their market cap numbers, and they won't have quite as much influence. So that would be a healthy way to see the index grow. And will it help the index-wide price-earnings ratio? That remains to be seen. But that would be just a theory on what could happen. I'm not saying that will happen. I'm just saying that is one of the possibilities we have to be ready for. Okay. I am still long-term bullish on here. Absolutely. I'm not looking I don't think there's any recession coming. I think we have more growth coming. It's like I said, you might see some period of volatility at some point in time in the future again, because once these baked-in prices start, buy the rumors, sell the news kind of thing going on. Again, be ready for it, but be ready for a bounce after that at some point for things to smooth back out. That breadth will come back, all right? I'm not worried about it. Just when and what we'll have to endure to get to it. It'll come, though. Okay, also looking at here now, we had my targets, my short-term price targets. That got really skewed a little bit. Now, I was originally at 71.50 for my short-term target. However, you saw that swing out target drop down to 69.85. There was a real big kink thrown in this. Okay, we did have one company, Booking Holdings, which had massive earnings per share before and a very high share price to go with it because they're massive price to earnings. Earnings per share. They actually did a 25-to-1 stock split. So it really brought down pretty good amount there. Because if you're having pushing close to $100 per share in earnings just for a single quarter, and you're over 300. Between $300 and $350 per share in 12-month earnings, that is up there. And then we have a good $5,000 or $7,000 share price or something for one share of this company. I forget what it was actually at. I will have to look at it again. But that's they should have been up in that neck of the woods pre-split. After the split, when you have, let's just for a good number, we'll just say we have $320 per share in earnings over a 12-month period from them. A 25-to-1 split is going to push them all the way down to what's that? I'm brain farting on it. It's like 1250 or something like that. Let me see. 320 divided by 25. Yeah, 1280 per share, down from 320. So that's a huge drop just from one company. And based on because my target is originally based on that, on just raw earnings per share weighting and not on market cap or price. Stuff like that actually has a big impact on what my target is going to be. So what's actually going to be a reasonable short, high and low short-term target, I have to figure that out. I know where the index was at earlier this week. I think it was over 7,200, 7,235 or something like that. 7230 is what it closed the week at, and it actually got to Good 72.50 at one point. Over 72.50, 72.65, I see at least. So it got up there. Is that a reasonable price for what we have going on, or is it maybe a little bit too ambitious? Really, I can see arguments in both directions on that, if I must be honest here. Again, if we can deliver over the next year or two on on stuff, then it might very well be worth it. But it doesn't mean that a bear market's going to come or a recession. It just means we're going to need a period of flat price behavior, or maybe even a brief correction of 10%, whatever, to reprice back to a reasonable level, and then continue back upward from there. Corrections are 10% drops or low or more, but they usually only last maybe a couple of months before the bottom is found, and then the price goes back up, right? So I know we're getting a little on the long here with all this info. Good info for you guys to understand, though, and my perspective on things. But that's where I see it. All right, I do see upward over long term. It's just some possible volatility that we can expect at some point. All right, so I'm going to take a look now at the companies that individual companies that actually reported this last week. For those of you guys who have an interest in buying, and trading shares of individual company stocks, all right. Again, the blue ones that you see here are the top 100s. I'll go ahead and filter by color there. We got 33 of the top 100 that actually reported this week. Alphabet, Apple, Microsoft, Amazon, Meta, Eli Lilly. There's we had like 6 of them with $1 trillion plus market caps. A lot of influence there. Let's see. I think it's in here. Okay, year over year performance. Now, out of all these, let me go ahead and we only had 8 of these report negative earnings performance. The rest of these, 25 of them reported positive earnings performance. And as you see there, Eli Lilly had the most dollar for dollar growth, but again, what numbers are we comparing? A 10% gain from $20 per share is $2 per share increase, or up to 22. But if you're only seeing a 10% increase from $2 per share, then you're only going from 2 to 20 to 220, or 20-cent increase in dollars per share. So just this alone can be misleading, but I'm more interested in the breadth. And where we have especially when we have higher dollars, let's say like this here, where it's a single digit trailing 12 compared to a bunch of other, it's surrounded by a bunch with double-digit earnings per share. That's usually an indicator that they might have a stronger performance than everybody else in that area that they're in. So like Amazon and GE Vernova. GE Vernova, when I was updating them, they had a really good report, and their estimated earnings over the next year, over the next quarters, I noticed they were very noticeably up from what I previously had for them too. So that one definitely looks like it could be a good buy. Amazon, I didn't pay that much, that close attention to, but again, actually, this looks like there's something wrong here. No, that's right. This is just year over year performance. These are the last 12 months, and these are the next 12 months. I am only comparing the most recent quarter, which is right there, to the same quarter last year, which is right there. Okay, that's what this number is for. All right, so, but just know that Amazon and GE Vernova, when you see that they're surrounded by a bunch of people, companies with $30 per share earnings and stuff, or even higher, or at least twice what they have, that usually bodes well for what their actual performance is. Same here with Alphabet, 13.11, when everybody else was 20 plus in that neighborhood with the year-over-year dollar, raw dollar amount change. Again, that says something good about Google or Alphabet, however you will. All right, so we look good there. Again, 25 up and only 8 down as far as the top 100 stocks on the index are concerned. Now, if you guys might be wondering, again, what are these peach-colored cells? I will tell you. Those would be the Dow Jones Industrial Average companies. Again, I'm not a fan of the Dow, but it is a widely looked at index, and I'm going to go ahead and cover it here. We had 12 of the companies out of the 30 report earnings, and as you see there, Again, we have only 3 out of those 12 reporting declining earnings. Merck and Company look the worst out of them, it looks like. Whereas Caterpillar, I did hear something about Caterpillar having a really good earnings report even before I did my updates. So praise be to them. Amazon also, again, we just talked about them. Microsoft, that's another a strong performer there. All right, Visa, that's another one that we want to look at because credit quality. If they're making good money, then not only more people using credit isn't necessarily a bad thing. It's how much trouble are people having keeping up on their credit card bills? When people struggle financially, the first thing they're going to slack on with their debts is credit cards. They're going to hold on to their auto loans and mortgages. The first thing that's going to suffer when push comes to shove, when it comes to credit debts, will be credit cards. So the fact that Visa is actually looking pretty good there, overall there, that's actually at least that's a good positive telltale indicator. Doesn't mean that it really is that we really are in good shape as far as credit's concerned, but it's an inclination that or an implication that we probably that we might be okay. Because if they're losing, if we're having problems with credit quality, and they're going to be losing money from write-offs on their credit stuff and whatever, or people aren't going to be spending as much credit. Visa is just really a payment processing service anyway, kind of like Venmo or Zelle when it comes down to it. So it's the Capital Ones or Bank of America's or other banks that actually use Visa for the processing that are really going to suffer. But still, if they're suffering, then I would expect Visa to suffer as well. And it looks like Visa is not suffering. So right now, Visa is expecting 11.74% earnings growth over the next year. So again, it looks at least a positive telltale indicator here. All right, so out of these companies, if you're looking for dividend-paying stocks, here's the list of the ones that have at least a 2% dividend yield. Now, a significant number of the companies in the S&P 500 do pay dividends. I think somewhere in the neighborhood of 400 of them, not ballpark, maybe a little more. I can't remember the exact number, but a good number of them pay very small dividend yields. Now, just the fact that a company pays a small dividend yield should not necessarily be a reason to not want to invest in them if that's what you're looking for. Because you also want to consider what is the company doing as far as stock buybacks as well. Because stock buybacks are a way that companies actually can give you artificial value growth where if they would be spending this money on dividends instead, you would still get the same value, but they wouldn't get the extra share. Basically, what do you call it? The voting the voting power. Or because they wouldn't have as many shares to work with. When you have let's just say 20%, or we'll just say we'll say 60% of all the outstanding shares, and 40% are available to the general public. And if you're just paying out a dividend, now the investors have to pay the taxes on those dividends, for one, and two, the company itself doesn't get to buy back the shares, and which creates a higher share price and also gives them more power over their own company as well. So, where they might have 60% of their shares, after they do a stock buyback, maybe it goes up to 62% or something. It might not be a huge amount, but it's any little incremental amount can put them in a stronger position as far as their strength on their ability to effectively run their own company, or have voting power with their company, whatever. I don't know. The downfall is the company ends up paying more taxes, basically, but you as the investor buying their shares, if you're not actually selling the shares, then you're getting more value from the share price going up because there are fewer shares available, but the market cap stays the same. And so that pushes the price up. And that's good for you as an individual. So again, that's why I don't worry too much about, depends on what your strategy is going to be. If you really want to do like a true drip program though, you want to look at these dividend yields here and maybe go for something that's a higher dividend yield. And I would highly recommend you also look at not just what's high dividend yield, but look at their earnings performance too. What did they last do? Their last year-over-year performance, and what are they expecting over the next year? Okay, so then I will sort these for you guys to see who has the largest ones. Alexandria Real Estate Equities has the highest dividend yield out of the companies that just reported this last week. They're at 9.86% yield. That is up there, way up there. But now, as you see there, though, their trailing 12-month earnings are at negative 627. Ugh. And their next 12-month earnings are still going to be in the hole by 25 cents per share. But now the dividend yield is based on their current share price of $41.39, and their current dividend yield per year is 408. So that's where that 9.86 comes into play. And as you see there, that 408 cell is green in color, and that means that they just increased their dividend since the last time I looked at their info. So that actually bodes well for them. And now I personally don't like to touch companies that are underwater with their earnings or expected, especially if they're expected to stay that way over the next 4 quarters or next year. But some of you guys might be more willing to take that kind of risk. All right. So just saying, this might be one to look at. If you buy, I don't know, $10,000 worth of Alexandria real estate, you're going to get almost $1,000 just from dividend performance alone, without even worried about the share price. You're going to get $1,000 just from nothing but the dividends on that one. And again, they just increased it, and they didn't decrease. All right, the other ones with high dividend yields right now, again, I want to look at, I'm going to filter these out for you guys, okay? Because this is a good way to screen so you can help figure out what stocks you might want to pay a special good attention to and which ones you might want to avoid if you're looking for dividend pairs. All right, year-over-year performers, I would demand it be greater than 0. Let's see, greater than 0. Okay, so we got 51 companies in here that have dividend yields of at least 2%, and they had a year-over-year performance of anything positive at all. The reason I say anything positive at all is because when they're negative, there's a better chance they're going to decrease or slash their dividend, whereas if they're reporting positive earnings growth, there's a better chance they're going to maintain or increase their dividend amount. So that's a good thing for those of you guys who are already owning shares of this stuff. Okay, expected growth though. Now you do see there are some here that are expected negative performance. I'm going to put greater than 0 as well there. And now we got 39 companies in here that fit that bill. So 39 that are year-over-year positive and are expecting positive year-over-year performance as well. And you see 2 of them actually decrease their dividend yields, dividend amounts, BXP and Lindendale Basel Industries. Basel, whatever, I don't know how that's actually pronounced, but Lindendale Basel, I'll just call it that. They're the only 2 out of this group of 39 that actually decreased their dividend. Everybody else either maintained the same yield amount or increased it. And all right, so you guys can work with this here, especially if you're looking for 4% or higher yields. And here's your 9 companies right here that you might want to look at: Alexandria, Verizon, Altria, BXP, Oniak, Franklin Resources, Stanley Black & Decker, Dominion Energy, Omnicon Group. Okay, those are ones that might interest you. Right? Not saying that any of these are particularly on my own list on my own radar, but they are, at the right time, they would be of interest to me. I'm also looking more at the sectors as well. I mean, the totality. I'll screen stuff, and I want it to be in a strong sector, not just a strong dividend performer within its own sector. Okay, this might be the last part here where I'll cover expected growth from these companies. Again, there are too many to look at here, so I'm just going to look at the more positive ones, from each category. To help you guys kind of maybe help more narrow down stuff. As you see there, I got expected dollar per share growth, for earnings growth. That's what I have it sorted by right now. Lindendale Basel, Alexandria, again, we talked about. Monolithic Power, Exxon. Most of the oil and gas stocks I saw that did any kind of updates for, they had, not surprisingly, much better than expected results. And very noticeably higher forward estimates as well. All right, Nucor, AbbVie. AbbVie, that's a biotech company, pharmaceutical company. Caterpillar, talked about them. Some good things to like about them. Now, again, I usually will personally look for companies with at least 20% earnings growth over the next year. So that's going to rule out some of these ones for me, like Meta. Their earnings per share growth percent is not high enough to interest me. They're in the right sector, then are in the right part of the sector for me. I'm not interested in software companies. I'm more interested in hardware and semiconductor companies within that, as far as the tech sector is concerned personally. Okay, Regeneron and Parker Hannifin. Again, those guys they're expecting growth, just not enough to really be worth it. I'd be better off investing in the S&P 500 than in those guys as far as, price. If we get consistent price to earnings growth, movement, I would expect better performance from S&P 500. It doesn't mean it'll actually be that way, but that's what I would expect based on that. Let's go ahead and move over to the bond yield curve now. This will be the last thing I'll cover here. Or no, I got one other thing I'll cover after this. That'll be real quick. Bond yield curve, I talk about it every week. This looks like a bullish bond yield curve. Actually looks possibly a tad more bullish than it was last week. I talked about inversions between the 1 month and I think it was the 1 year, somewhere in that neck of the woods there. Yeah, there was a little bit, a very small amount of inverting going on between some of those, but no inverting at all between these short-term bonds and the longer-term bonds. Everything's just from the 30-year down to the 2-year here. It goes upward. I'm still a little bit concerned about what's going on with the 20-year bond. Why does it keep getting up right around the same level as the 30-year? What's going on there? What's causing that influence? I don't know. Home equity yields, home equity loans or business loans, I would imagine are where that's at. Because when those yields are going up, that means that there's inflation in that particular area. And what would be causing inflation in that particular area? That would be my best guess. Home equity lines of credit or business loans, more particular than anything else. All right. Otherwise, very little inverting. 3.68 as the bottom, as the lowest yield you see on anything here. That's the 3-month yield. Then it jumps to 376 at the 4-month, and then comes back down to 371. But then it starts climbing the rest of the way up. So overall, again, we're looking all right there. I've talked before. The 1-month yield is always a good way to look at what the bond market is predicting as far as Fed rate policy is concerned. I think their last meeting was was it in April? Let me double check when their last schedule was. Yeah. Okay. The last meeting was just this last week. I didn't hear anything different. They kept the rate the same as far as I know. Next meeting is June 16 and 17. It's always a Tuesday and Wednesday when they meet up. I always got about a 45-day interval as well for those of you guys who might want to know that little GWiz info. But yeah, generally the 1-month yield is going to stay right about where the Fed funds rate is currently at. And, Fed funds rate is currently in the 3.5 to 3.75 range. And so I would, as you see here, it is staying right around 375. And usually I do expect that right before the Fed meets, I usually tend to see the 1-month yield move a little more rapidly in one direction or another, depending on what they're actually anticipating the Fed doing. So if we anticipate a rate increase to the 375 to 4 range, then I would expect in the week or within the week before the next Fed meeting in June, I would expect the 1-month yield to start climbing up to above 3.9, maybe even 395, as a possibility, at least 385 if nothing else. Now that would be a little bit more of a bet that the Fed is going to increase the rate. If they stay somewhere in the neck of the woods of 375, that means they're betting that the Fed is going to keep the rate where it's at. And then if they start pushing down more toward 3.5, then that means that they're betting on a rate cut. That's basically the easy way to explain that, right? But right now, look like we're still staying in that general territory. Speaking of that, I forgot to even pay attention to the fact that the Fed is meeting next week. What do we have for 1-month yield? The lowest it got was 3.66%. That was in early April. So, and the last meeting was just this last week. It briefly got below 3.7. It's been mainly hanging around the upper 3.6s for most of the month of April. It actually got up to 3.7 on the 27th, which was the day before the Fed meeting. But then it went right back down to 368. And now it's back up above 3.7 now that the Fed has actually finished their meeting. Well, this was a busy week. Had a lot more to cover than I normally do, so I apologize for the video being as long as it is. But again, that's because there was so much to cover with these, with how many companies reported this last week, or that I was paying any attention to at all. Next week hopefully it won't be as busy. Hopefully the next week's video won't be quite as long either, maybe half as long. And Yeah, and then after that, it should really help slow down. There won't be quite as much to really update you guys on after that. So, if you guys watched all the way through this, thank you for having the patience to make it all the way through this and hopefully absorb as much as you could out of this. Maybe make some of your own good investment decisions based on it, whatever it happens to be. I will end this now and appreciate you guys watching. Thanks for watching.